First of all, good afternoon to everybody who is joining us from Europe. I'm very happy to share this first session of the International Workshop on Financial System Architecture and Stability. So this is, Basma, this is the 6th edition of our conference. Which in fact we started several years ago in Victoria, face-to-face, fortunately back then. And I hope we will continue our international conference yearly face-to-face, hopefully from next year when the COVID situation allows it. So I'm very happy as the president of the Euro-Mediterranean Association, together a professor at the Cass Business School. Now it's becoming the base business school, City University of London, together with University of Victoria, Basma, and all the colleagues, the hosts who have worked with us to organize this conference, to start this first session. So this first session, as you can see, it will last 1.5 hours. It's on the real effect of ESG and environmental regulation. So I would like to ask the speakers, so we have 3 papers, 3 presenters and 3 discussants. And also have my colleague Sandra Shalita. She's a researcher at the Euro-Mediterranean Economics Association, which she will co-share with me this session. So I will start with the first paper on the product market competition, innovation, environmental regulation, by colleague DUAN from Vienna University of Economic Business. So please, the floor is yours.
Thank you, Rin. All right, let me just start sharing my screen. Okay. Everybody can see it. Okay. All right. All right, thank you very much for giving me this opportunity to present our project in this session. This is a joint work with Ray Dye from Wharton's and Professor Lilian from York University, Toronto, Canada. This is a paper on the relationship between product market competition, innovation, and environmental regulations. So the growing concerns over environmental issues have triggered numerous environmental regulations and policies in the US over time. And along with it, the potential costs associated with these policies have become one of the most controversial political issues that the society faces. Some of the policymakers believe that these environmental regulations would crowd out productive investments, hamper performance, cost jobs, are ultimately detrimental to economic growth. And there are numerous empirical studies to back this belief up. But then there's also some others that argue, and of course they have found some supporting evidence that environmental regulations may actually be beneficial to the firms as they encourage their fostering of green innovation in response to the increased regulatory pressure, which in turn may help the firms in enhancing productivity and facilitate their firm performance. Given these mixed firm reactions to environmental regulations, it prompts our study to ask the questions, do firms respond differently to these regulations, particularly or in particular to the fostering or the investment of green innovation? What's driving such differences? And of course, what are the consequences of such differences? And we find that the competitive environment that the firm operates in plays an important role in determining how firms respond to regulations. In particular, firms facing more intense competition would generate more green innovative output in response to regulations than firms that are facing or they're operating in less competitive industries. So, which kind of implies that environmental regulations may actually do more good to those firms that are facing more intense competition than those that are facing less competition. So of course, the natural question would be, why is competition an important determinant to how firms respond? To answer this question, we first have to think about why firms foster green innovation. And as I mentioned in the 2 slides above, some firms use green innovation as a means to comply with environmental regulations, which at the same time can help them to at least partially offset some of their regulatory burden by enhancing their firm performance through things like reducing process inefficiencies, increasing product value, or helping the firms in gaining competitive advantage through better product differentiation against its competitors, etc. But these green innovations are risky investments with uncertain outcome. So firms facing different conditions, or they're operating under different conditions, would have different incentives to foster green innovation. And we expect that competition will be one such key condition for two reasons. So first of all, environmental regulations are costly, right? Because they may lead to higher production costs and or reduced market share. And competition would increase such cost. For example, firms that are facing less competitive pressure would be less threatened by these regulations or regulatory pressure, because they can push a lot of those costs to its customers with little worries about losing a lot of its market share. But as competition intensifies, more and more firms will be increasingly more concerned about how regulations would affect or negatively impact some of their existing competitive position in the product market, which provides a stronger incentive for them to invest in green innovation in order to alleviate some of those regulatory burden in place. And the second reason is related to the firm's incentive to escape competition. So less competitive firms, or firms that are in less competitive markets, have fewer incentives to innovate, because some of their innovations may actually replace their own existing competitive strength, which makes there are fewer gains to such act or such innovation. But as suggested by prior studies in the CSR literature, firms respond to competitions by increasing their engagement in CSR practices as a way to better differentiate themselves against its competitors. So in a similar vein, we expect that firms that are operating in more intense industries would be more willing to foster green innovation in response to the regulation, or in complying to the regulation, and simultaneously try to escape competition. And using the newly available plant level data from Dun & Bradstreet, we are able to examine how firms respond to county level regulations or regulatory shocks in the US. So just a quick preview of our key findings. In the event that county level regulations in the US become more stringent, we find that firms that are in more competitive industries generate more green innovative output in response to the regulations relative to those that are facing less competitive pressure. And these more competitive firms seems to be able to better maintain or even gain their competitive strength from such innovative response, which is reflected from better product differentiation and attraction of corporate customers, which ultimately leads to better post-regulatory product market performance as proxied by market share growth, profit margin, and markup. Okay. So we use two measures to proxy for firm level competition, the total product similarity score and the fluidity score. Both are from Holberg and Phillips data library, and both scores increase with competitive pressure. And as a robustness test, we also use the industry level HHI indices, and the results are qualitatively similar. And as for the green innovation, we use the innovation output data from PatStat to construct two measures of firm level green innovation. So first, we classify a patent as either green or non-green based on its patent class. So a patent is considered as green if its patent class can be found in the list of essential green technologies as identified by the United Nations Framework Convention on Climate Change, and the list is available on WIPO. So after we identify all the green patents, we aggregate the total number of those patents as filed by a firm in a year as the total quantity of green innovation, and of course we aggregate the total number of forward citations received from those green patents in all subsequent years as the quality of the green innovation, and both measures are adjusted for sample truncation. And to our best ability to capture some of the county level green innovative activities that the firm has in order to maintain its local local access to its local market, we also construct two measures of county level local green innovations. These measures are similar to the firm level proxies, but in this case, the green patents is essentially the total number of patents that are cited by local corporate customers, and the green citations are essentially the number of forward citations received from the local corporate customers in all the subsequent years. And as for the identification strategy, we use a commonly used approach in the economics literature. So essentially, we employ variations in attainment versus non-attainment status across the different counties as exhaustion shocks to the county level regulations in the US. So the Clean Air Act in the US mandates this nationwide air quality standard known as the NAAQS, based on a few representative air quality or air pollutants. And this NAAQS standard is being used as a benchmark for each county to evaluate its own air quality. So, and this set of standards gets reviewed and then revised by EPA once every few years. And once this revised set of standard kicks in, it triggers a whole new process where the county it needs to be designated as either an attainment zone or a non-attainment zone. So counties that pollute in excess of the NAAQS standards are considered as non-attainment, and those who pollute less than NAAQS will be considered as attainment. And then the polluting plants that are residing in the non-attainment counties are subsequently subject to much stricter regulatory monitoring, enforcement, and emission limitations, etc., than those counties that are in attainment status, until these non-attainment counties are brought or they fulfill all the criteria to be brought back to be an attainment zone. And they remain that way until a new revised set of standards kicks in, and then the whole new redesignation process starts all over again. So we use this switch between this attainment and non-attainment status in different times across different counties to trigger the shocks to county level regulations. And using these components, the first test we conduct is to examine how well a regulatory shock affects the firm's innovation decisions, particularly what is the role of competition in this relationship. And in order to study this relationship, we employ a triple difference framework, which is essentially just a diff and diff, but with additional interaction terms with the competition measures. So the traditional or the conventional post times treat coefficient tells us the basic treatment effect for firms that are facing less competitive pressure. But what we're really interested in is the triple interaction term, which tells us the incremental treatment effect for firms that are facing higher level of competition. And the dependent variable, of course, for now will be the green innovation measures for firm in 2 years or 3 years ahead. For the baseline, we look at the way we control for firm, county, and a year fixed effect separately. But as robustness test, we also control for firm, county times year fixed effect in order to eliminate any systematic differences across the counties that could confound the causal interpretation of that non-attainment regulatory shock. And this is the result for regressing against the firm level of green innovation, and all other green innovative measures are quite similar, which I'll skip later on. So what's interesting to note is the basic treatment effect is all negative and significant. It suggests that regulations may go as far as inhibit some of the innovative activities for firms that are in less competitive industries, which is still consistent with our hypothesis, because as I mentioned, these kind of firms have fewer incentives to innovate because of the replacement effect. So regulations can further crowd out some of those incentives. But what's more important that for us is the incremental treatment effect, which are all positive and significant, suggesting that relative to the firms that are facing less competitive pressure, the more competitive firms, they tend to tends to generate more green innovative output in response to the increased regulatory pressure, which is again consistent with our hypothesis that competition encourages innovative response to environmental regulations. And our next set of tests is to examine whether the innovative responses from these competitive firms can actually help them in maintaining or better maintaining or gaining their competitive advantage post-regulatory shock. In particular, what we want to see is the differences in product differentiation and the customer attraction after regulations. Using patent originality as well as the negative value of the average product similarity score as the proxies for product differentiation, we see a sort of a similar pattern where the triple interaction or the incremental treatment effects are all tends to be generally positive and significant. It suggests that yes, firms facing a stronger competition are more likely to be better, be able to achieve product differentiation after the regulations. And to the extent that the green innovation and product differentiation can help firms in generating more business after regulation, we also look at the total number of customers at the firm level as well as the number of customers at the county local level. And once again, a similar pattern arises, which we see a positive attraction of a positive incremental treatment effect for firms with facing greater competition. And further analysis on the ratio of non-green customers to green customers, it seems like this attraction to corporate customers seems to concentrate on those customers that do not generate green innovation themselves, but more likely to be more reliant on external generated green innovations, which is quite interesting. Which suggests that it is the green innovation that sort of attracts the additional customers or the additional business by the competitive firms. And finally, we just want to see what are the consequences to the different firm responses, and we look at the firm level performance measures such as market share growth, markup, and profit margin, because we don't have plant level data. And of course, we see a very marginal negative coefficient for the basin treatment effect, which suggests that yes, that environmental regulations do harm the firm performance for those that are operating less competitive industries marginally. But what's interesting to see is that this negative effect weakens and then eventually reverses for those that are operating in more competitive industries, which suggests that environmental regulations that may actually do good to some firms, particular to those ones that are more competitive. And in conclusion, we find that competition plays an important role in motivating the firm's response to environmental regulations, which in turn affects the firm's performance after regulation. Particular regulations are more effective in encouraging green innovation, right, for competitive firms, and these competitive firms can better achieve product differentiation, customer attraction, which ultimately leads to better post-regulatory firm performance, which implies that environmental regulation can do good to firms, especially to those facing intense competition, which we think is an important addition to the literature. And thank you very much. I think I'm a little bit over time, but thank you.
Thank you very much, Louis, for this very good presentation. Let us move to the discussant, who will be done by Victor Song from Simon Fraser University. Please.
Hi, Ran. Thanks so much. It is my great pleasure to discuss this paper, and this is my third time to attend this conference. So I think this is a very interesting paper. The authors examines the relation between competition and the firm's response to environmental policies, and it provides a very comprehensive empirical evidence such that firms in a more competitive environment are more likely to undertake green innovation when facing strict regulations. And then, they found that competition is the key driver resulting in this strategic response. And also, the author found that this innovative response may also help the firm increase product differentiation, attract more customers, and also increase market share, profit margin, and profitability. And also, it can create more jobs. So, and my comments, I have 3 comments here. The first one is in terms of the competition effect. So the authors argue that firms facing higher competition may have a stronger incentive to engage in this kind of green innovation. But the question is, the relationship may not be may not always be linear, right? So, for example, if a firm in a monopoly position, it has a very weak incentive to innovate, as the firm dominates this market. On the other hand, if a firm in a perfectly competitive market, there might be no need for the firm to innovate, as because this response cannot improve its market position. So my question is, this kind of competition effect or benefit may only apply for a certain degree of competition for one industry, right? So because the competition effect may only apply for a certain degree of competition, that's why I may imagine there might be a kind of inverted U-shape relation between the degree of competition and the innovative response. So in this sense, one quadratic function form may be more appropriate to test, right? So this is my first comment. The second comment is the cost associated with the increased product differentiation. So the authors argue that this green innovation increases its product differentiation for the firm engaging this response. But my question is, this investment may also increase firms' marginal cost, because the firm are producing high quality product, right? So in this case, the effect of a competition on firms' performance may capture the total effect, since the marginal cost issue has not been considered in this regression, right? So this is my second comment. The third comment is in terms of labor demand. The author argued that firms engaging innovation create more jobs and maintain labor demand. So the innovation increases the product differentiation and also expand its market share. So each firm engaged in this innovation becomes much stronger. So then they are able to hire more people. But my question is, not all firms are able to survive under these strict regulations. And not all firms have the capacity to undertake this innovation. So on one hand, each survived firm may create more jobs as they are stronger than before. They have more capacity, they need more people. But the aggregate labor demand may be reduced, since I would imagine some firms may have already left the market, right? So if we think about I would imagine the total number of firms may be lower under this kind of strict regulations than before, right? So the overall Herfindahl index may be higher than before, right? So this is my basic 3 comments. It is my great pleasure to discuss this paper, and hope my comments may offer some help to polish that. And thank you so much again, for inviting me to attend this great conference. Thank you so much.
Thank you, Victor, for keeping the time. Would you like to would you like to have to respond to Victor on the points he made?
Yes, that would be great. Thank you. So thank you very much, Victor, for the comments. They're very well taken, especially, the first point as to the nonlinear relationship between competition and the effect of environmental regulations on innovation. This is actually what we're considering as well, because we also understand that it might be U-shaped relationship, the trade-off between the Schumpeterian effect and the escape competition effect. And this is actually what we are trying to work on too. So thank you so much for that point. It's very well taken. And yeah, and as for the last point, I want to sort of go into more detail as to the notes on your slide as to not all firms are able to survive under strict regulations. And I do agree with some of your points in terms of the total aggregate labor demand, but in terms of the effect of those particular points that you point to that may affect my other results, I kind of want to address that. So first of all, not all firms are able to survive under strict regulations, and which may reflect some of the firm performance in aggregate. We've actually tried a robustness test where we're only looking at the plants that exist both prior and post the regulations for some time. So we did that for robustness test. So as far as what may affect other firm performance or other economic consequences, this is robust to it. And that's all as to not all firms undertaking innovation and hence how valid or externally valid this relationship is. As a simple restriction, we have already taken out those non-innovative firms. So we only look at those innovative firms, disregard whether this firm is green innovative or not. But as far as patent production or patent application is concerned, we have only included those who have a history of filing patents. Yeah. So,
yes. Okay.
Thank you so much. Yeah, but as for your general comments on labor demand, thank you so much. I agree with it, and this is something that we need to work on. Thank you.
I see. Okay, thanks so much. Yeah. Okay.
Thank you very much, both on this presentation. I don't know if anybody from the audience would like to make a question to Rui on the paper.
Yeah, good morning, Rui. It's Michael King out in UVic. I enjoyed your presentation this morning. I had a question about the sort of time series of green patenting that you're seeing in your paper. I'm wondering, it would be quite interesting to see whether over time you're seeing an increase in green patenting, and then showing just a simple graphic of competitive versus non-competitive industries to show, to kind of motivate your paper and show that there's greater green patenting activity in those competitive industries. And lastly, I had the same comment as Victor about the sort of threshold effects of competition, whether there's a certain level that really matters that is really driving this green patenting. Thank you.
Thank you very much, Michael. These are great comments. Again, thank you so much for the suggestion about the nonlinear relationship. And it's a great idea to show the time series against the competitive and non-competitive firms. Thank you.
Any more questions from the audience?
I have a short question. This is Vikas from the University of Alberta. So the paper is very interesting. My question was more with regards to what extent do firms actually buy the green technologies using mergers and acquisitions, using their competitive strength in that industry. The reason I'm asking this is that if a whole bunch of firms do this, that will simultaneously change the concentration in that industry as well, making it less competitive while they're doing this.
Thank you so much for the great comment. That's actually quite interesting. And we didn't consider merchant acquisition particularly, but we did think about whether this whole regulatory shock would simultaneously affect both the competitive post-regulatory competitive environment. As you said, it could reduce the number of firms and hence the competitive pressure, and simultaneously green innovative incentive. So one of the ways that we did try to eliminate one of those effects in order to just look at the effect on green innovation is to have a shock on competition in the first place, which is so sort of a two-dimensional identification strategy where the shock we introduce is the import penetration, and just prior to the shock. But absolutely, you're right. It might be the case that the identification strategy for regulation may simultaneously affect both the innovation and competition afterwards. We'll look into that further. Thank you so much. Yeah.
I have one question, Reid. Have you tested for the effect of tax incentives to introduce environmental activities within the companies?
Yeah, this is also one of the comments that we received previously, and this is something that we are trying to address in our next version. Yeah. Important that we're trying to look at. Thank you so much. Yeah.
Thank you very much for this very interesting paper. Now I'd like to give the co-sharing of this session to Sandra. Sandra, you can proceed with the second paper.
Hello, everyone. So I'm very happy to co-chair this session with Reem. We will move forward with the next paper presented by Stefano PISERÁ from the University of Essex and the University of Udine. Do ESG practices lead to higher firm productivity? Evidence from Europe. So Stefano, the floor is yours.
Yeah. Hi, everybody. Thank you very much. So I will share the screen. Okay, 1 second. Okay. Can you see?
Can you put it on full screen mode?
Yeah. Okay. Can you see now?
Yes.
Okay, perfect. Okay, hi everybody. Thank you very much to be here. I'm really happy. And today we talk about a paper I'm writing with Claudia GIRARDONE and Luca GANDULLIA. And the title is Do ESG practices lead to higher firm productivity? Evidence from Europe. Okay, as we know, after the global financial crisis, there's been a great interest on the potential benefits deriving from greater firms' engagement in corporate social responsibility. And these issues are obviously increasingly relevant, especially for firms that perceive CSR as a means to boost their productivity and to allocate resources and use on social capital. Anyway, whether this great focus on CSR affect firm productivity during period of economic slowdown hasn't yet been tested. In fact, what we know is that the corporate social responsibility literature talk basically as about the impact of being engaged on firm risk, for example, on market value, but just a little about total factor productivity measured at firm level, because TFP represents a collection of important productive and intangible assets, and moreover is one of the most important measure of medium and long-term economic value creation. Looking at the literature, the selected literature, few studies test the relationship between sustainability and firm productivity, but usually focus on single aspects, such as, for example, investment climate, or environmental aspects, or gender diversity, or labor diversity. But no one so far touched the CSR concept on all environmental, social, and governance, and its single and individual pillar components. And therefore, basically, there exist two theories on the link between CSR and performance, two different theories that predict an opposite results. The first one is the stakeholder theory, which argues that stakeholder welfare can be considered an intangible asset, so predicted the relationship with value and productivity is positive. An extension of the stakeholder theory what we can consider an extension is the so-called moral capital theory that expand the stakeholder theory, explaining and empirically showing that CSR may act as a sort of insurance cover for a firm that generates moral capital, especially during period of crisis. On the other side, on the opposite side, the managerial enrichment and over-investment view, as its origin in agency theory and is based on managerial opportunism argument, and predicts an opposite output for firms that invest in CSR, a negative impact. Therefore, we to test if exists a link between ESG and firm productivity, we examine the link of the single environmental, social, and governance factor on firm total factor productivity, both in terms of composite score as well as its individual pillars. We focus on the European case because European firms are early adopters of sustainability practices and thus are leader in some way in this field compared to firms headquartered in other geographical areas. And moreover, the test on European firms allow us to explore the environmental engagement and productivity nexus after the adoption of the 2015 Paris Agreement. Therefore, our hypotheses are three, and the first one is that firms' ESG score and its individual pillars positively affect firms' total factor productivity. Basically, this is based on the stakeholder theory. The second one, the hypothesis, is that the impact of firm ESG score and its individual pillar is stronger during post-crisis productivity slowdown, and therefore after 2012. And again, this is based on the stakeholder theory. The last one, hypothesis, is that the 2015 Paris Agreement yields as a sort of a rewarding effect in terms of productivity for firms more engaged in environmental friendly activity practices. And this is based on the moral capital theory. Okay, to test our hypothesis, we focus our analysis on listed firms headquartered in Europe with ESG scores that are available from Thomson Reuters Refinitiv, both at composite and individual levels, obtaining a final sample of 560 firms covering 15 European countries over 2002 to 2018. All ESG scores range between 0 and 1, with higher values indicating stronger performance in ESG. And we employ two popular methods of firm productivity. The first one is the Woolridge total factor productivity. And the second one is the Levinson and Petri total factor productivity. Basically, the higher are the TFP values, the greater is the firm's productivity. Okay, in this slide, we can see a sort of plot of our two measures of total factor productivity. And as we can see, besides are two different computation methods to compute total factor productivity, the trend is quite similar. And as we can observe from the time period after 2008, we have a drop in total factor productivity that basically is the consequence of the global the great financial crisis. And after the 2012, we can see another decrease in total factor productivity trends. But how we compute total factor productivity? Okay, basically, total factor productivity can be obtained as the residual from a Cobb-Douglas production function with capital, labor, materials as input factor, and value added as output. Therefore, we estimate the total factor productivity using two semi-parametric methods. The first one is the Woolridge, and the second one is the Levinson and Petri. Moreover, we obtain the TFP as the residual of the Woolridge and the Levinson-Petri using as firm's input factor the fixed capital as a proxy of capital factor, the number of employees as a proxy of labor factor, and the difference between total expenses minus labor expenses as a material factor. Okay, and therefore, to test the relationship between ESG and total factor productivity, we basically run a panel fixed effect regression, where TFP is the measure of our productivity measure. And in the multivariate regression includes industry, country, and time fixed effects. To control for issues of reverse causality and endogeneity, for example, we after run a lot of robustness tests, like for example, the instrumental variables, the Ekman, and the PSM regression. Okay, let me show our baseline model. And as we can see from the table, all ESG, environmental, social, and governance factors are positively correlated with both TFP measures. Basically, if we look at the coefficients, we can see that the stronger and the higher in terms of magnitude of the coefficients is the environmental one, followed by the social, and finally by the governance factor. Then, if we split our sample running the same multivariate final fixed effort regression from before 2012 to post 2012, that is identified as a post-slowdown period, post-crisis period, and we can see that the coefficients of environmental, social, and governance factors change both in terms of magnitude and in terms of statistical significance. In some way, indicating a sort of stronger effect during a period of economic slowdown, such as that after 2012 in Europe. Finally, to test our last hypothesis, we test the impact of the 2015 Paris Agreement, the announcement of 2015 Paris Agreements on firms more engaged on environmental, social, and governance factors. As we can see, we postulate that the ESG firm productivity linkage may show a higher reward for firms with higher scores. Obviously, to strengthen the validity of our difference in difference, we consider the high heterogeneity among firms by using a PSM weighted difference in difference regression built around the 2050. As we can see, our group of interest, that is the dummy shock interacted with the treated group, is positively and statistically correlated with both measures of productivity. If we consider that our treated group are firms more engaged and with firms above the mean value of ESG score in the year of the shock, while our control group are firms below the mean value of ESG scores. Therefore, by running the difference in difference regression, we confirm the existence of a sort of moral capital theory predictions. Therefore, to test other problems that may occur after running a panel fixed effect regression, we run a lot of robustness tests, such as, for example, to control for sample selection bias, we run a Neckman two-step method, an instrumental variable generalized method of moment estimator to check for endogeneity bias by strictly following the literature on CSR, and therefore we use the industry and year periods value of ESG score as instruments that basically is found to be not correlated with our dependent variable, but strongly correlated with our instrumented variable. Then we run a panel fixed effects regression employing Bloomberg measure of ESG score and the ESG combined score. We run also a PSM weighted regression to check for firms' performance differences by dividing our sample between higher engaged firms in ESG versus lower engaged, and thus we obtain a sample perfectly matched, and so we in some way remove all problems related to firm-specific controls. Finally, we run our baseline model by using an alternative measure of productivity, such as, for example, the capital productivity, the labor productivity, and the all-in MPX TFP. To sum up and conclude, when considering the aggregate ESG score, engagement in sustainability practices are associated with higher firm productivity. And this happened basically, especially during the post-crisis economic slowdown. When we further explore the ESG score individual pillars, our results reveal that greater effects can be attributable to environmental score. And we confirm this finding by running a difference in difference regression around the adoption of the 2015 Paris Agreement, which confirms that during the productivity slowdown period after 2012, firms more engaged in environmental and governance practices were rewarded by the sign of the Paris Agreement, confirming in some way the moral capital theory assumption. Our we believe that the main implication of our paper is that the positive role of ESG strategy on firm productivity is supportive of the strong and recent European Commission commitment on sustainable finance. Moreover, our results suggest that engaging in environmental, social, and stakeholder-oriented governance practices are associated with a more efficient firm's production input allocation. Therefore, we suggest that sustainability performances should be materially considered by regulatory authorities, as it is very useful, especially during a period of productivity slowdown. That's all. Thank you for your attention.
Thank you very much, Stefano, for your comprehensive presentation. Our very own Paul Schure will discuss this paper. So
I think I need to. I need you to unshare. Yeah, that's awesome. Yeah. So let's see how this goes. Does the sharing work?
Yeah.
Awesome.
Perfectly. If you can put it on full screen mode, it would be perfect.
Full screen mode. Yes. What I have that. Should be.
The view. No.
Let me just share my I'm going to unshare and reshare, but as a different, just the whole window, the screen share. No, probably it works. Does this work better?
Perfect. Yeah.
So, yeah. Well, thank you for allowing me to discuss this paper, and it's a pleasure as usual to be at this conference. I've seen this conference grow as well, and was there at most previous editions, I think all but one. So it's a fantastic thing. It is a workshop, and so because it's a workshop, I decided I'm going to make workshopy comments on this paper. So the main question of this paper is, can you be doing well by doing good, right? And they cite the origins of this quote. And here in this context, doing well means enhance the profitability and value of the firm, presumably. And doing good means make investments in CSR, in corporate social responsibility. And the standard measure these days for corporate social responsibility are the ESG factors. And so the strategy of this paper is to look at the influence of these ESG factors on firm productivity as measured by total firm productivity, right? Now, if you have a Cobb-Douglas technology, it looks, the Cobb-Douglas function looks like this. I'm circling this with my mouse. I'm not sure whether you can see the circling as well. Then the total factor productivity is simply the A. You're estimating the A, right? And there's two measures in the paper of the A. One is the Wooldridge measure, and the other one is something else. So there's two ways of establishing that. Yeah. So what are the findings? So the findings are, yes, the ESG factors do boost total factor probability. So yes, you would be doing well by doing good. And correct me if I'm wrong, but I inferred that especially the E, the environmental factors, help a lot. And then also at some stage, the analysis is split between prior to 2015 and post 2015. So in a downturn post 2015. And it turns out that ESG helps particularly well after the downturn. And this is what you mean by possibly it can be helpful in terms of a hedge for firms. Right? So what are the contributions? So the claimed contributions are, this is the first paper to link ESG to total factor productivity. And sort of total factor productivity is a standard measure, and environmental, social, and governance measures are also the gold standard these days. So this is a big thing. There's this link. Since this link has been established, you can analyze what the link does in sub-periods, and the periods prior and post 2015 are compared. And then there's the focus of the European Union. Now, regarding the contributions, I said these are the claimed contributions. Unfortunately, I don't have the expertise to speak to these contributions. What I can say is it would be helpful, I think, to make the contributions even clearer in the introduction. I would take numbers 1 and 2 together, right? It's like you draw a link between ESG and total factor productivity. Once you've drawn this link, you can use this to comment on sub-periods as well, right? But don't make them 2 separate contributions because it looks a little bit strange from a reader's point of view. Just present it as one contribution, and then the pre and post allows you to talk a little bit more to the contribution. And the focus on the European Union is helpful, but on the other hand, I'm then also wondering, and sort of make this also super clear, does the focus on the European Union mean that you're the first one to draw the link between ESG and TFP in the context of the European Union, or are you the first one full stop, right? And so that is something that this reader at least didn't sort of pick up on. So make that crystal clear what the contributions are. So my overall impression, this is an important question you're addressing. I'm totally fascinated by the paper. I'm not convinced, but I have little to argue why I'm not convinced. I'm not unconvinced either. I need a little more to be convinced. And therefore, what follows below are some skeptical questions that ultimately have the goal to make the paper stronger, right? So that's my intention. So lots of questions of what would be a skeptical referee, so interpreted as such, right? It's not necessarily only reflecting my skepticism, but I think some referees would have similar questions. And the difficulty, I have to say, in this paper is that there's so much going on. You have to somehow make choices of what to include and what not to include, because if you include everything, it becomes too much for a reader, right? So one thing, this is not in the slides, where I would say maybe you can sort of cut down on is the hypothesis development, right? So maybe you can have more the approach in this paper that you can let the data speak, because the hypotheses I don't find are particularly strong, and they almost look like they've been created to confirm what you later find in the data, right? And if that is the case, you may as well say, okay, you know what? I just let the data speak, right? Yeah. So the first question is inviting you to strengthen the story why there would be a relationship. And this is probably also explaining why I am a skeptical reader. I was it from the beginning, right? Sort of, I was thinking, why would these ESG factors even influence total factor productivity, right? I'm an economist, and I'm thinking, well, these investments in ESG, so doing good, could be almost like a moral obligation. If it is a moral obligation, it becomes like a restriction to the firm. So how can it be that sticking to the restriction can be making the firms do better, right? So that's sort of the background in my head, why I'm sort of, that explains my skepticism, right? But then for the governance part, I can see it. I can say if you force the firm to be proper in terms of governance, you know, that should boost productivity. But the governance part is not the strongest result. The strongest are the environmental part, right? So now what is the exact mechanism with the environmental and the social? And there you push stakeholder theory, and sort of stakeholders push firms, they also reward firms. And in this case, maybe the story could be, well, if you have happier workers, you also have more productive workers, right? But I feel that this story can be fleshed out a little bit better, right? You also appeal to some empirical evidence that's useful, but again, the story is the most important, I think. And the happier workers, more productive story, right? Which is workers are, of course, stakeholders, right? Does that add up with your evidence later on in the paper in table 9, where you basically show that actually the productivity gain comes from the capital part, not so if you have total factor productivity, labor productivity, capital productivity, and it's actually the capital productivity that seems to explain the best. So can you then still keep up the happier workers, more productive workers story? In general, the question is, can you strengthen the story? Second question, so the data and TFP, it is, you know, I'm just going to say we need to learn more, but this depends a little bit on which journal you're going to send this paper to. And I'm generally wondering, is this a finance journal paper or an economics journal, right? So in economics journals, they know a lot more about TFP, and in finance, they arguably know a little bit more about ESG. So I don't know. One thing that puzzled me a little bit is you have 560 firms in this data set, 17 years. If you multiply the two, you have just short of 10,000 observations. But the tables are based on just over 4,000 observations. So is there a type of sample selection going on that explains this, right? I know you have endogeneity tests, but this was in general sort of something that I would need as a referee to be more convinced about. So then the main model. So the main model is summarized in table 2. Beautiful paper, a beautiful table also. And then when I looked at this table, I was thinking, okay, so these controls here that you put in, sort of, why does it make sense? Is there a good story in the paper for putting in these controls? And in particular, when you think of firm size, sales growth, and leverage, you could make the argument that these 3 variables are sort of co-determined with ESG performance or ESG scores. They're almost like endogenous to the firms, right? So then I was wondering, what happens if you leave out these endogenous factors, right? So if you, for example, remove size, does that sort of completely swing the regressions, or what happens to these regressions? So in this paper, you do a lot of robustness checks, but you don't really sort of look at what happens to simple experiments if you sort of add a factor or remove a factor, etc. The other thing that I would like is that you
still have 1 minute.
1 minute left. I'll be super quick. So put these things in the other tables as well. There's no cost to that. If I have 1 minute, I'm going to just say that I'm going to send you my questions. But let me go to my bottom line slide, right? So the bottom line is, can you be doing well by doing good, right? So first of all, the question is, who is you? And there's like 3 perspectives. Can one be doing well by doing good, right? Who is one? Who is the person we're talking to? And you can think of, it could be the investor. Could the investor be doing well by doing good? Or could the firm be doing well by doing good? Or could society be doing well by doing good, right? And this question, who is you? Who is the person we're talking to? Affects the journal that is targeted, right? And arguably, if we're talking about society, then we should be targeting an economics journal. If we talk about investors, then it's a finance journal. If it's the firm, then it's sort of in between. And then I was thinking about this paper. Are we talking about society more or more like the investor? I would say this seems to be more like, you know, a society type paper, right? It does look as CSR as an investment, so it's suggestive of firm, but firms could be interested in shareholder value or value, right? Whereas here it's about productivity, right? And productivity is interesting to a regulator, right? To society. So here, and plus ESG factors are presumably also controllable by regulators, right? So this is my last slide. So let me just conclude my last slide by asking the last line.
We don't have a lot of time left.
Yeah, minus 5 seconds left. If the target is a finance journal, then the question is, can investors be doing well by forcing the firm to do good, right? This productivity gain, does it translate in shareholder value somehow, right? So that was one question I was remaining with, but I would also say it's not an important question if you do not target a finance journal. But if you do target a finance journal, it will probably be a nagging question to the referee. Thank you, and sorry for going over time. Half a minute.
Thank you very much, Paul. It is very interesting. Maybe before I give you time to reply, Stefano, to see if we have questions from the floor. Andrew?
Yeah.
Kevin, Andrew, yeah.
That's okay. Just a quick, I'm also thinking about the interpretation of these results, and I just want to clarify something. The productivity measures that are used in the paper are measures of revenue productivity. So a lot of the discussion today was about worker productivity and those sorts of stakeholders, but the way that productivity is identified, it could also be demand side factors. So customers rewarding the firm, because it's with these methodologies, it's impossible to isolate demand shocks from supply shocks. And then the other comment I had was about selection. You did the Heckman two-step selection. I believe the Ollie-Pecos estimator has built into it a way to control for endogenous exits. So there might be a way to kind of do that in the first stage of estimating productivity. And then you have a productivity measure that is consistent with endogenous selection, which is always an issue with these types of unbalanced panels. Thank you.
Thank you very much. Any other intervention? Okay, so Stefano, you have 2 minutes.
So, yeah. Basically, I want to say thank you for the discussion. I ask you if you can send me the slides so I can check with calm all your suggestions. It is a deep and really detailed discussion, really helpful for us. So thank you again. So this is my thank you for the possibility to discuss the paper. Thank you.
Thank you very much, Stefano. So Paul will send you his remarks, and we will move with our next presentation of Guanming He. Does CEO debt-like compensation mitigate corporate social responsibility? Irresponsibility. We are talking about CSI. So Guanming, the floor is yours.
Thank you. Yes, as you said, the main theme of our paper is about CSI rather than CSR. We do not expect all the firms to be socially responsible because there exists benefits versus costs of making socially responsible investment and operations. Just imagine the financially constrained firms, the startup companies, they may not afford to be socially responsible, too nice to stakeholders, donate too much. But for those financially healthy firms, those publicly visible firms, those firms that have a good growth prospect, perhaps the benefits of CSR will outweigh the cost of CSR. But nobody would like to see, no stakeholders, no market participant are willing to see that someone acting socially irresponsibly at the expense of others. And this is a widespread of concern among the practitioners and the academics. There's some couple of research showing that, yeah, indeed the market participants, the investor, care about the CSI, say the environmental concern, but not necessarily the CSR, and because perhaps they understand there is a cost associated with making the socially responsible investment and operations. And then there's a consensus that the CSI has adverse economical consequences to firms because nobody likes the CSI happening on a firm, and there's some penalty, market penalty. The two type of example I illustrate in the paper is the British Petroleum and the Volkswagen is well heard examples. This scandal make the company lose a lot in the market value. So given this CSI is a general severe concerns for our academics and practitioners, so one might ask, what's the mechanism that might mitigate the CSI and make our market a fair play, the fair place to play in for all the market participants? And this is the broad questions we aim to examine in this study. Regarding the difference between CSI and CSR, obviously conceptually they are opposite, but they can coexist based on the existing evidence. On one hand, there might be some opportunistic incentives behind the CSR activities. And some socially responsible firm might behave socially irresponsibly. For example, the Volkswagen, the example I mentioned in the previous slide. Before the scandal was discovered, the company claimed itself as a corporate citizens and advocates its social and ecological commitments on this website. This is ironically. And on the other hand, some socially irresponsible firms might might pursue some CSR activities and show to the public, oh, hey, I'm socially responsible, at least in some aspects, to disguise some of their socially irresponsible behavior or other potential corporate bad news that are happening on its relationship with the stakeholders. So given the CSI and CSR coexist simultaneously, it's important for us to isolate the CSI from the CSR. And in this paper, we use the media coverage of the ESG incidents to capture the CSI, and isolate to purge off the CSR. The research questions, as I mentioned, is to see how to curb the CSI behaviors. There are two ways. The first way is through the monitoring mechanism, but you know it's a little bit costly, or may not be efficient to curb the CSI all the times, because the monitoring indeed is costly. It's unlikely that every day we can monitor on the CSI well. And so it could be better to have the managers to self-discipline themselves from the CSI. So it's good to look at the compensation policy. And here we look at the debt-like compensation. Why we call debt-like is because it's the money that the company owes to the CEOs. The compensation has been deferred, so it's like the debt. So we call the debt-like compensation. It consists of pension and other forms of deferred compensation. And we would like to see whether this debt-like compensation will help to mitigate the CSI behaviors. As I mentioned, the CSI is captured by the media coverage of the ESG incidents, and in this table we give all the examples of the ESG incidents that we look at in this study. We cover, for example, the overuse and wasting of resources, animal mistreatment, discrimination in employment, social discrimination, so on and so forth. We use the REPRIS data to capture the CSI, which is measured by the media coverage of ESG incidents. The advantage of this, the RRI score constructed by the REPRIS companies, that it can capture the severity, reach, novelty, timeliness, frequency of the incidents covered by the media. So it's a composite measure, which is developed using the proprietary algorithms by the REPRIS companies. All right. So why we use this REPRIS index? Because it's not based on the subjective analyst rating. You know the conventionally used KLD, the MSCI database. Their CSR concerns are based on the subjective analyst rating that are conducted on a fixed intervals and are frequently based on the self-disclosed information rather than the actual outcomes. And you know the managers in general have incentives to withhold bad news, including the bad news on the ESG scandals. And what's more, the MSCI's database give the same weight for all the ESG concerns, but the REPRIS we distinguish the major incidents from the -1 through measuring the reach, severity, novelty, timeliness, and frequency of the incidents. So this is the reason why we use the REPRIS data for our study. The nature of the debt-like compensation make the CEOs risk averse. Why? Because if the company go into bankruptcies or the companies then a high likelihood of defaults, then the CEOs might risk not being able to get back their money. So in general, those CEO holding large insider debt are risk averse. Let's go to the story of our paper. Our story is built on the SMJ paper published in 2017. Their paper showed that the media coverage of ESG incidents will expose the firm to a high default risk. So the basic rationale behind is that if the company is subject to the media coverage of the ESG scandals, their reputation will be tarnished. So it will make it more difficult to finance their investment and operations, and also difficult to contract with its stakeholders. The stakeholders do not trust the firm. So the potential consequences of this is that the default risk will become higher. Okay, the trade credits and external financing become more difficult. Yeah. Since the ESG risk exposure will exacerbate the firm's default risk and diminish the expected value of the CEO debt claim, so we expect that the CEO holding large insider debt have the incentives to contain the ESG risk. But this does not mean that we will have a we will have a negative association between the CEO insider debt and ESG risk, because although the CEOs holding large insider debt have the incentives to lower the ESG risk, they might not be able to do so. Okay. If the CEOs, albeit having the incentives to lower the ESG risk, but fail to do so, fail to effectively control the ESG risk, then we will expect no relationship between the ESG risk exposures and the insider debt holdings. So we leave this association between the insider debt and ESG risk as an open question, and lay out our hypothesis in a null form. And we have the results speak for whether the alternative hypothesis hold or the null hypothesis hold. To test the hypothesis, we used traditional Granger causality design. Basically, we take the 1 year lag of the dependent variables and we include it as a control in the regressions. And we have all the independent variables measure 1 year lag behind the measure of the dependent variables. The sample we use are drawn from the Executive.com database and the RepRisk database. And here we have to end our sample period in the year 2015 because of the data availability. Our university all of our co-authors subscribe the data up to that year. So that is the reason why we stop the period in that year. The insider debt measure we use are the absolute measure of the insider debt. That is, we divide insider debt by total assets. We do not use the relative measure because it mingles together the effects of both the debt-like compensation and equity compensation. And what's more, the CEOs can make the adjustment in the equity holdings from year to year in response to the anticipated future risk exposure. So if we use the relative measure, it will subject our results to the endogeneity issues. Okay, but the flexibility here, I highlight the flexibility of making yearly adjustment in the debt holdings is much smaller than the equity holdings. So we do not consider the equity holdings in the measure, and instead we control it in the baseline regression. So this is our baseline regression results supporting our alternative hypothesis. And there's a reverse causality concern for this paper. That is, the socially irresponsible firms are less inclined to pay their CEOs with insider debt. But we like to contend that this reverse causality is less of a concern in our study because the compensation committee, the company has to follow strictly the provision and the formula of the debt compensation in the compensation contracts. It's unlikely that the firm can change the debt-like compensation in anticipation of the future increased ESG risk, unless there's a strong reason for the change. Otherwise, all the employees or all the including the compensation committee have to abide by the contract, which has been negotiated and confirmed at the very onset. But anyway, to rule out this concern, we just split our sample into the two subsamples based on the above or below the median of CO insider debt. And we find the statistically significant results only in the subsample with high insider debt. And that's rule out the reverse causality concern. And due to the data limit, it's not that feasible for us to conduct an actual experiment or the two-stage least square. And we just use this approach to mitigate the reverse causality concern. We also consider other tests to mitigate the correlated omitted variables bias.
2 more minutes.
Omitted, 1 more minute. Omitted one. Okay, sorry. Omitted variables always exist, but the issue concerning us is whether it will be qualitatively overturn our inferences from the results. As you see in this table, the ITCV value is all higher in absolute value than the impact value of all the control variables. That means even the omitted variable exists, it will not bias our results. We also conduct a placebo test by examining the association between non-senior executive insider debt and ESG risk. We do not find the statistically significant results, therefore further mitigating the correlated omitted variables concerns. We also do the change-on-change analysis instead of the firm-fixed effects, because the firm-fixed effects will be multi-collinear with the industry effects. And it's important for our paper to control for industry dummies, because the insider debt and the ESG risk vary systematically across different industries. So we have to think the change-on-change regressions and our inferences hold. So I have to jump to the summary of our results due to time limits. We indeed find a negative relationship, and this relationship is stronger where for the financially constrained firms, low credit rating firms, and those firms that have a younger CEOs or softer tenure CEOs. The key contribution of our study is that while the prior literature focused much on examining the economical consequences of the CSI or CSR, but little is known about how to curb the CSI effectively. Our study provides a potential feasible mechanisms through which the CSI could be mitigated, and this is the main contribution of our study. One caveat of our study is that we do not speak to the optimal level of the CO insider debt in minimizing the ESG risk. But that said, we hope that our findings will have some implication for the compensation committees when designing the compensation contracts for the CEOs, and also considering the curb of the CSI behaviors by the firm. That's it for my presentation. I hope it's on time. I look forward to the discussion, discussing our paper. Thank you, and all the comments and suggestions are welcome. And thank you again for listening. Thank you.
Thank you very much, Guanming. So the floor is for Sadok Ilgul to discuss your paper. The floor is yours.
Sure, just a second. Okay, thanks to the conference organizers for inviting me to discuss this paper. My name is Sadok Ilgul. I'm with the University of Alberta. I'll be discussing this paper about CEO inside debt and corporate social irresponsibility. So So the main research question of this paper is the following: does CEO debt-like compensation, which we call generally inside debt, this is comprised typically of defined benefit pension claims and deferred compensation. So what would be the impact of inside debt on corporate social irresponsibility? So the underlying idea of this paper is the following, is that inside debt is unsecured. The value of inside debt claims is inversely related to corporate default risk. So if the firm is bankrupt or liquidated, inside debt could be worthless. That would motivate the managers or CEOs to reduce firm risk, including corporate social irresponsible behavior, for the simple reason that engaging in socially irresponsible behavior would damage the reputation of the firm, would make contracting with stakeholders more difficult, and that, of course, would increase firm risk. So the main hypothesis of the paper is that inside debt, CEO inside debt, would deter corporate social irresponsibility. Now, in terms of implementation, the paper uses a sample of about 2,000 firm year observations from the US over the period 2007 to 2014. It measures corporate social irresponsibility using rep risk scores. These are measures of risk exposure to ESG issues. CEO inside debt is measured from executive comp, if I'm correct here. That's the present value of defined benefit pension plans plus the balance of deferred compensation plans, all divided by total assets. And a simple regression that controls for known determinants of corporate social responsibility. In those regressions, the authors document a negative relationship between inside debt and corporate social responsibility. In additional results, the paper shows that that negative relationship between inside debt and corporate social responsibility is more pronounced for financially constrained firms, firms with high risk, high default risk, and for firms with younger and shorter tenured CEOs. So that's very interesting paper. I thought that it was well executed, but the positioning of the paper in the literature was probably lacking. This is for sure a paper that belongs to a large literature about the determinants of CSR or CSI. I can cite a couple papers, but this is an enormous literature. Previous documented determinants of CSR include analyst coverage, supply chain. This is, I think, a paper by Lilian, showing, for example, that socially responsible customers tend to contract with socially responsible suppliers. Another paper showing that product market competition, when the market is competitive, firms tend to be more socially responsible. Ownership structure includes family ownership, institutional ownership, block ownership, also have impacts on CSR, cross-listing, internationalization, CEO characteristics. CEOs with daughters, for example, are more socially responsible than others. So the link to this literature is probably missing. The link also to a new literature that shows essentially that firms increasingly tie CEO compensation to CSR criteria, including papers by Caroline Flammer and Frank Lee at Western. this literature is kind of not cited, not discussed in the paper. But more importantly, there are a couple papers that look at the relationship between CU and side debt and CSR, including this this paper. Sorry, including this paper by Kim and co-authors, another by Wu and co-authors, another one, a short one by Sheikh. All those papers kind of tackle this research question. I think the paper here is different because it looks at irresponsibility as opposed to responsibility. So I would expect the authors to better clarify the contribution of the paper to this literature. Now, my second comment is just to be fair here. It applies not only to this paper, but to all papers like exploring the determinants or the consequences of CSR, is that there is mounting evidence now that ESG scores are divergent or unreliable. I'm citing a couple papers here, not all of them, but I have a whole folder now in my disk, in my computer. I could probably about 20 papers documenting that ESG scores are not reliable. Dimson and co-authors, for example, document that ESG ratings from different providers provide different assessments of the ESG profile of firms. This one, Yang, this is still a working paper, but it speaks directly to this paper. He looks at rep risk scores and essentially finds that higher rep risk scores do not predict future bad behavior. So rep risk scores in this paper, are not very informative about future bad behavior. Berg and co-authors.
One more minute. Sorry.
Yes. Sorry.
One more minute.
Okay. So this is to say that it's probably important to confirm the validity of risk scores and probably to cross-check those scores against data from other providers or independently constructed scores. The paper does a good job at linking inside debt to CSI, but the problem is that what I find missing is that other aspects of compensation, like total compensation, executive, like equity-based compensation. The Greeks, Delta and Vega, especially Vega, which is linked to risk-taking incentives. The pay slice is also missing. The paper also does a good job at addressing endogeneity and identification. What I find missing, though, is an instrumental variable analysis. Came up with something. CEO personal tax rate. When CEOs have high current tax rates, they might have incentives to defer compensation to the future, and then maybe variation across U.S. states probably can give you some variation here. And finally, I'll close by probably suggesting to look at some outcomes. So the idea here is that inside debt reduces corporate social irresponsibility, but does this matter to shareholders? Is this reflected in higher valuation, lower cost of capital, or lower risk? So an outcome analysis might be informative here for outsiders. Thanks a lot. I hope I'm on time. I had a couple other comments, but I will share them with the authors after the session.
Thank you very much for your comments. Maybe before making you reply, Guanming, see if we have any questions from the floor. If you
Thank
can
you
stop
for
sharing.
the discussant's comments. Yeah.
if we can stop sharing so we can see if we have any questions. Nothing so far. Guanming, if you want to reply.
Yes, thank you. As you heard from my presentation, I have said a lot about the differences between the CSI and CSR in our research context. Our aim is to distinguish our paper from those 4 papers. Actually, are concurrent papers. There's some delay over our working process for this paper. Yeah, and the story, the findings are different. We believe we have tried our best to state the differences in the paper, but we don't want to criticize those paper in directly unless required to do so. Secondly, regarding the instrumental variables, we may select to do a 2-stage list where we do consider that by using the state tax rate. But we find due to our small sample, we do not find a sufficient variation in the state tax rate, okay, in our sample. So we forego this test because there's assumption underlying the two-stage list where the instrumental variables will strongly explain the endogenous key independent variables. For another concern you raised that the rat risk index might not be associated with a poor performance in the future. Perhaps it is possible that the firm will learn, will do something good to mitigate the adverse impacts, the adverse economical impacts of the media coverage of the ESG incidents. That could be a possible reason. But anyway, we believe that those scandals discovered by the public will have a detrimental impact to the firm, holding all else constant. Although empirically, statistically, we may not find, some study may not find the negative association between the CSI and the future performance, possibly because of the effects of the learning and improvement of the firm over time, but we believe that it will have a detrimental impact on the firm, and every firm should avoid behaving socially irresponsibly at the expense of other stakeholders' interests. Yeah.
Thank you very much, Guanming.
Thank you again for the constructive comments. Yeah.
Maybe two more points before we close this session. First of all, for the next session, you need to register on another Zoom link that will be shared on the discussion part. And secondly, we would like you to, if you can turn on your cameras, everyone, so we can have a group photo for the beginning of this conference. I don't know if we need to unpin the, yes.
It certainly takes less time than if we had a photographer taking a live picture in person.
So it could be that you need to put it on the gallery view, but
yes.
I think everybody has a different view, right? Everybody has
we need to put it on the gallery view.
And then the person who records it has to put it on the gallery view, and then probably.
So I am on gallery view, so I think that it just depends for each of you if you select gallery view.
You can. I have already taken a photo. Thank you very much, directly from a gallery view.
Thank you very much, yeah. George. You are here.
Thank you. Thank you very much.
Of course, I am always here. And thank you for many thanks to all the speakers. It's very interesting start for this conference.
So thank you again for this beautiful first session. Very interesting. We have a break. If you would like to network or discuss, we can stay on this on this channel, but please don't forget to to register for the next keynote speaker. Thank you very much.
Yeah, I think the link is also on the website. It's probably one that you don't have to register for. I don't know, but maybe
okay.
Maybe Cheryl can comment on this.
So you can register for it to get the link, or you can, yes, you can go through the
You
website.
still need the link. Okay, I have the link. Everybody who
Perfect.
registered got the link. I have the link, but I thought it was also posted on the website, but apparently that's the link to register. Yeah.
Great. I'm going to head over there now as well, just to get set up, but I'll open it up at 9:15. So I'll see you guys then.
See you later
See you.
then.
Thank you.
Thank you.
Thank you. Bye-bye. Bye.